When it comes to understanding the mortgage market, sources of financing for real estate, and what products are out there, it's helpful to be able to distinguish between conventional versus conforming mortgage loans. Conventional mortgages are a broad category of loans that are not offered or secured by a government agency, such as the FHA, VA, or USDA. However, these loans can be insured by private insurance companies or guaranteed by Fannie Mae and Freddie Mac, which are, in fact, privately held companies. Conventional mortgages are particularly well-suited for borrowers with good or excellent credit. They are considered the basic standard of home loans. Because they're offered by private companies, conventional loans tend to have stricter requirements and slightly higher interest rates. The qualifications are on the conservative side, meaning lenders take on less risk with these loans. For example, in most cases, borrowers must have higher credit scores, above 700, to get the best rates. The homebuyer must make a down payment of at least 20%, and to qualify, they may need to have a debt-to-income (DTI) ratio of no more than 4 to 5%. Debt-to-income ratio is the percentage of monthly income that is spent on debt payments. Exceptions can be made depending on the borrower's full financial situation, although each case depends on the individual lender. Conforming mortgages, on the other hand, are loans that may be secured by private companies or government agencies. Popular conforming loans are backed by the FHA and VA. Conforming loans not provided by the government can be conventional loans. Conforming loans, conform to the loan standards required for purchase on the secondary market and have an annual national conforming limit set by the FHA. The national conforming limit is the maximum amount for a loan to be considered a conforming loan. However, the conforming limit does vary in some places in the country. Let's touch on a few other distinctions between the two terms. Conventional mortgages generally pose fewer hurdles for the well-qualified buyer compared to a conforming FHA or VA mortgage, which may take longer to process and have additional requirements for qualifying both the buyer and the property. A downside of the conventional mortgage is that only borrowers with excellent credit, a good DTI, and a sizable down payment will benefit. Another way to look at the two loan types is that all conforming loans are conventional, but not all conventional loans are conforming. Conventional loans can be for more than the national conforming limit, for example, but they may be backed by a government-sponsored enterprise like Fannie Mae for only the amount of the conforming limit. Understanding terminology in the industry, such as the differences between these two terms and where they overlap, will allow you to navigate the world of mortgage money more readily and assist your clients with more confidence.